We'd like to say that in 2015, despite all appearances, the Australian securitisation market was actually the most active in the RMBS sphere in the world. That probably explains why some of my colleagues in Australia have been unable to send us even a single line about the Australian securitisation market. And I am entirely reliant on Chris's notes to talk to you about it, since I personally only do English securitisations. But we do work with our colleagues all the time. So not only has it been the most active market in 2015, but in terms of the volume itself, it's a constantly growing market, and there was over 30 billion in issuance last year in both RMBS and ABS. The Australian Securitisation Forum is also looking beyond the borders of Australia, and in the last year has been actively working towards trying to help develop the New Zealand securitisation market. So it's a market which is prime for development, and it is now focusing its efforts there. So good news for everyone who is looking to expand. Now, in terms of issuers in the Australian market, it is clearly a very ripe and mature market, since not only banks but non-bank issuers, mutuals, regional banks, and corporates are all issuing. That is a very healthy market, and it is something which a lot of the English market would really aspire to for the moment, as rather frozen at present. So, as I said, we'd like to welcome you here. For those of you who are hoping for a coffee break, there isn't one, but there will be coffee and water outside. So if you do need to need a glass or a coffee to get through, though, especially for those of you who might be jet-lagged, definitely do not hesitate just stepping out. Other housekeeping, the toilets are quite hidden away. As you come out and you go around here, they're along the corridor parallel to the side of the room. Lastly, wanted to point out that you've all got on your chairs a copy of the Australian Securitisation Journal, the latest copy, which you're, of course, all welcome to take away with you. So without waiting, I'd like to pass over, and we're going to look at the outlook for the Australian economy, banking and residential property markets. Thank you.
Thanks very much, Vanessa, and thank you for again hosting us most generously here in London. And we're going to kick off firstly with an overview of the Australian economy and the outlook and prognosis for that. And we are fortunate to have an expert to cover that topic. So I would like to introduce Gavin Friend from National Australia Bank. Gavin is based here in London, and he's a senior market strategist. And I'd ask Gavin to come to the podium and get into his presentation and not talk about the weekend's football. Thank you.
Thank you, Chris. Well, good morning, ladies and gentlemen. Thank you once again for taking the time to come and listen to us today. Now, I've got a bunch of slides to go through. I'm not going to touch too closely on housing because Chris is going to cover that after me. Suffice to say, I've got quite a lot to get through, so I'll apologise in advance if I rattle through some of these slides quite quickly. If you do have any questions, then I'm happy to take these perhaps afterwards once we've got through the busy agenda. So, here's our Australian growth profile. This is quarterly growth going back over almost a quarter of a century. And the standout observation, I think, on that is that the resilience of Australian growth. We've only had 3 negative quarters in 24 years, almost a quarter of a century. No technical recession, because we've just had 1 single quarter each time. The 3 quarters of negative growth were in 2011, when we had the Queensland floods. The other 2 quarters of negative growth were global events. So we had the Y2K, which for Australia was not a particular issue. Australia, not that tech heavy. And then, of course, the GFC in 2008, 2009. Here, it affected economies around the world in different ways. Australia fared well. We had started the mining boom, of course, at that point, but the crucial thing for Australia is it had the capacity to act at the time. And by that I mean Australia went into the global financial crisis in a good position. They were running very low debt, budget surpluses. This is Australia's budget or debt situation as it is today. Debt around 18 or 19% of GDP, heading up towards 20, but against its peer group, still in a very comfortable position. Now, I'll come on to that a little bit further on, but the important thing for growth is that we have it's set the scene for almost a quarter century of uninterrupted growth, no recessions at all, which I think sometimes is easily forgotten, a pretty remarkable performance. One other way of looking at growth is growth levels. So here what we do is we anchor growth at an index of 100. Here we've taken 2005, just before the GFC, and then we pile on every year as it comes in after that. And you can see Australia's done phenomenally well against its peer group of leading advanced economies. If we look here, this is our GFC global financial crisis downturn, barely registered for Australia. And since that point, the peak that we had heading into the global crisis, growth in Australia has gone up by 20%. New Zealand, it actually suffered a little bit more than Australia, but it's done well. In contrast, if you look at the US, of course the GFC affected the US a bit more, but since that point, growth really has only risen 8 or 9% above the old pre-crisis peak. In contrast, if you look at Europe and Japan, now Japan, a big trading nation, like all trading nations, suffered worse during the global financial crisis, but both Europe and Japan are barely climbing above their pre-GFC highs. And I think, obviously, that's one of the reasons or one of the factors that UK or British citizens will be thinking about when we vote next week about whether to remain in the European Union. Now, for Australia, it's been a story of two halves. We've come off, as you know, a once-in-a-100-year mining boom. And so we've got here growth split into what comes from mining and what comes from non-mining. Whoops, and you can see, the right slide, you can see non-mining growth, or mining growth I should say, is down at, it's been below zero, now just stabilising a little bit towards that zero line. 3 weeks ago, Australia released Q1 GDP data. Q1 GDP grew by 1.1% on the quarter, 3.1% on the year. That's pretty strong. And, you know, if we know that, as this chart says, mining growth is zero or below zero, then by definition it's telling you that the non-mining economy is travelling pretty well at the moment. And it forced the RBA in its statement last week, when it left rates unchanged, to note that other areas of domestic demand, as well as exports, have been expanding at a pace at or above trend. It's a long time since the RBA has used those kinds of words, above trends. So what's going on in growth? NAB produces a monthly survey of business conditions and business confidence. It's widely read. The RBA likes to note this in its commentaries. The chart on the left is conditions and confidence over the last 15 years or so. And you can see the red line, which is our business conditions. This is things like profitability, employment, forward orders, those kinds of things, pushing nicely up above its long-term trends, long-term average. Business confidence tends to lag a little bit behind. That said, it's still now just about pushing up from its long-term average. We get the next reading on this tomorrow, so we'll be watching with interest to see where this goes. The chart on the right is really just the bigger picture in terms of business conditions, and you can see, you know, wind the clock back where we are now. It's pushing up, you know, steadily, slowly towards the series peak. If we drill down into specific sectors and specific states in Australia, we can see areas such as, I'll get this thing right in a minute, areas such as household services, which is healthcare, finance, property businesses in the green and the brown. They're doing quite nicely. They're rolling over a little bit, but they are at series highs. At the same time, we've got transport and construction doing reasonably well. Mining, of course, we know the story there. Wholesale and retail, not so well. And that's, we think, because, You've got this weakness in the Australian dollar, which we think is going to continue for the moment. And that, of course, means that, Australia can't purchase as much as it can do with that weaker Aussie dollar. So cost pressures go up for wholesalers and retailers, and it seems at the moment that they're not able to pass that on to the buying public. That's a question mark we've got there, and we're just waiting to see how that pans out over the coming months. It might be that the lower rates that the RBA is pushing through starts to help to offset some of that, but we need to watch that situation. If we look at conditions by state, no surprise that Western Australia heavily hit by the mining sector. Non-mining growth, though, non-mining states looking good. Partly mining, again, pushing up above that zero line. Now, what else is driving the economy? We know exports is a big driver. A lot of that comes from LNG production, but it also comes from tourism. Tourism and education are, if you combine these two, are now overtaking coking coal in Australia as the second largest exporter. We can see passenger arrivals here, up from Japan, pushing up from the US, steadily climbing the UK. New Zealand, that little bit coming off there, I think is just really, guys going back from, as the mining sector down tools. China is the growth story. That's where most of the short-term passengers are coming from. And if we look at two charts here for tourism and education, and we've put the contributions to growth over the Aussie dollar, both of these sectors are quite sensitive to what goes on in the currency, particularly over the last few years. So we can see here, if we look at the, we can see here, if we look at the, that's better. This is the peak in the Aussie dollar. So the Aussie dollar is down about 30% against the US dollar from its peak in 2010. It's down about 20% on a trade-weighted basis from its peak in 2013. And you can see that as the contribution from tourism or from education picks up, and then it turns down as the Aussie spikes up. And again here, it plateaus out a little bit as the Aussie spikes up. But then as the Aussie falls here and here, you get this upsurge in education, an upsurge in tourism. As I say, these two sectors now are combining to be the second largest export in Australia, and the weaker Aussie dollar is a central part in that development. Here's our student numbers coming in from various countries around the world. Last year, in 2015, 645,000 full fee-paying students came into Australia, contributing some $19 billion to the economy. The estimates are that this will rise to something like between 700,000 and 1 million students over the coming years. And all this is good for the working age population. The working age population is a central ingredient for healthy economic growth. We've got New Zealand up here as well, but Australia doing well there against its peer group. And you compare that with some of these other countries here, in Europe, Germany in particular, Russia, Japan, no real growth in the working age population, which is a bad sign in terms of economic growth going forward. Now, all of this is good for the labour market in Australia and a sign of a healthy labour market. You could argue that pulling down the jobless or the unemployment rate, you could do that by just having fewer workers turning up. That would be a sign of an economic contraction, but the prior chart tells you that isn't happening in Australia. To the RBA's surprise, they've had to revise down their jobless rate forecast. So a year ago, they were looking at the unemployment rate ticking up from 6.25 to something like 6.75. But over the last year, Australia has seen the labour market turn for the better. Australia is now producing something like 18 to 20,000 jobs per month. The monthly numbers are quite volatile, but it's above the 14 to 15,000 jobs that Australia needs to produce in order to keep the unemployment rate steady. So on these forecasts, and NAB is doing quite a lot of work with a company called Seek, which does a lot of deep dive analysis into the labour market. And if we look at what we're getting back from our NAB survey, this is telling us that the jobs market is actually very resilient and probably likely to continue going this way. So we've got a jobless rate that's tending to trend lower. Ordinarily, this would mean this kind of labour market dynamic, even though we're not yet at full employment, ordinarily this would tell us that the RBA ought to be raising rates with these kinds of dynamics. But of course we know it isn't, and we know that last month it cut rates to a historical low of 1.75%. Why did it cut rates? Because the RBA is a medium-term inflation targeting central bank, and the inflation numbers were so low that it felt, and it looked at the risks, of course, it felt it needed to act. Now, just to remind ourselves what happened to inflation in Q1, numbers we got out about 3 weeks ago, headline inflation fell 0.2 percentage points to 1.3% on the year. The core rate, which is what the RBA, of course, cares about, rose by 0.2 percentage point. That was the lowest ever for an annualised rate of 1.5%. And of course, that 1.5% takes us below the RBA's 2 to 3% target. Here we go. This is fantastic. The 2 to 3% target range that the RBA likes to focus on. Now, there were a couple of mitigating circumstances in that CPI report. Oil fell 10%, fruit fell 11%, and these two things combined pulled 0.4 percentage point off of headline CPI. And you could make a fairly compelling argument that what is going on in the oil and commodity markets at the moment, with the way that oil has rebounded off its lows, the way that these things will run off the annual comparison in the data over the next few months, that from the oil sector we might start to get some rises in CPI, not just in Australia, but through all of the industrialised and advanced economies. That's something we think we could see over the coming months. But for Australia, there was weakness elsewhere. There was no pass-through, for instance, from the weaker exchange rate in areas such as clothing and footwear, household equipment, communications, recreation and culture. Now, we had thought, as had the RBA, that lower exchange rate would be pulling through some price rises there. It stands to reason. The Aussie is cheaper. It buys less abroad. Why wouldn't those prices go up? Go back to the chart I showed you with the retail and wholesale sector. For some reason, either the wholesalers can't pass it on to retailers or retailers can't pass it on to the consumers. Something's going on there. This is something we need to watch. So we might argue, is this just a temporary phenomenon or is it something that goes on? This is something that the RBA will be considering. If we look at tradable and non-tradable inflation, we know there's no pass-through from the weaker Aussie. On the tradable side, there were things going on in the housing market, which of course interests you. Lower rents. We know that we've got the APRA measures coming through. We know that we've got more capacity coming online and a healthy pipeline, and that's bringing down both dwelling prices and rents, absent the little blip that we've seen in the last month following the rate cut. So housing is almost a quarter of the CPI basket on the headline. So that's one reason why CPI was lower. But if we look more broadly, we've got a whole range of factors that are pushing down inflation. One is this global backdrop with commodity prices around the world crashing down behind oil from the middle of 2014. Although we've seen a bit of a bounce here, there's a good argument in terms of supply and demand that suggests we're going to be buffeting around at these kind of levels for the moment, and actually we're not going back to plus $100 for oil, and therefore, from a global perspective, commodity prices look like they're kind of stabilising at the moment. We've got, as I've mentioned just now, extra housing capacity, which is weighing on CPI. Little evidence of pass-through from the lower Aussie. You have this supermarket price war, which is the other thing that's going on that's connected to why retailers and wholesalers can't pass the higher prices on. And we've got this dynamic of low global inflation. It's in New Zealand. It's not so much in the US, but it's certainly in Japan and parts of Asia, and it's certainly in the Eurozone. And we don't quite know where this is going. And then, of course, there's unusually low wages. Again, it's not just an Australian phenomenon. It's happening elsewhere. Here's our average weekly earnings and labour cost index. You might argue the labour cost index is being dragged down by a surge in Australian exports, which is increasing productivity. If that's the case, that probably won't last much more than a couple of years. But average weekly earnings down there, trickling lower. There is a case to suggest that Australia, relative to other countries, needed to lower its wage cost to get more in line with other countries. But we're getting down towards those levels now. There's something else going on. And of course, this is a topic that economists around the world are debating in all sorts of countries in terms of what's happened to labour markets in light of the GFC. It's something we don't know. Labour markets continue to press down. There doesn't seem to be any traction for workers to go on higher wages. And then just looking more broadly, we come back to this dynamic of supply and demand in commodity markets and how this is weighing on things. The chart on the left shows you oil supply and oil demand. Now, you know, in 2014, we had a crash in the oil price as the dollar ramps 25% higher. And the crash in the oil price, regardless of the link with the dollar, was really because shale was coming online, much more capacity. That supply-demand imbalance shifted towards oversupply. And as prices creep up now, you can argue that some of those shale producers will come back online. They'll find it more advantageous. It's a business model that apparently is quite quick to turning on and off. And so even if the prices run up a little bit higher, as they may well do in the coming months as base effects drop out of the annual comparisons for oil, you might find the shale guys come back online, just increasing supply, and that limits the price. And we're moving around in a sideways, fairly narrow range from where we are now. But it certainly it suggests that in the broadest sense, there's a limit to how high these prices can go. There's also a lot of overcapacity. We can see this in China. We see this in China steel as China rolls over. Chart on the top right is vehicle registrations in Europe, US, China, going off the scale in US and China. Again, it suggests how far can this go, that there's an overcapacity going on. And then inflation expectations, crucial for the RBA, moving down there on the right-hand side. The further they go down, the more the RBA is going to wonder whether it needs to cut rates again. Now, it's not our forecast at NAB that the RBA will cut again. You know, it cut in May, and then if you saw the policy statement last week for June, it clearly looked at what's going on, and it gave no explicit easing bias going forward. If you compare that with what the RBA did in 2015, in February and March, it cut rates in February and then left an explicit easing bias, and we knew in the next month they would probably be cutting again. That hasn't happened this time, so it's suggesting at the outset that the RBA feels comfortable with its current policy settings, that these will return inflation back up to that 2 to 3% over time. And it suggests they feel comfortable with what this will do to the employment market. It knows, it can see the non-mining recovery travelling quite well. It can see the labour markets are quite strong. It will be looking at things like the NAB business survey. Business conditions are quite healthy. And it knows also, it's very aware, as its recent commentary suggests, that it's cognizant of what's going on in the housing market. You know, it can see more supply coming online. And it can see also if it cuts rates further, it might upset that. So it's very cognizant of these areas. If you look at the RBA's forecast for inflation, you can see that their prior forecast in February, they were looking for inflation to return to about 2.5%. The new measures in blue there just see it dipping and then going back, returning to where it was. So arguably, that's suggesting that they are comfortable that policy has probably hit a bottom. That's our view at NAB because, in part, of the things that we see going on in the non-mining economy. It may well not turn out to be right. The RBA may feel it has to cut again, but it probably won't be able to make that decision until it sees the inflation report for Q2, which comes out on the 27th of July. This very colourful chart is Australia GDP. The yellow line through the middle is your annual growth. Each vertical bar represents a year's worth of growth and how that growth is derived. Where does the growth come from? So you've got there in the grey a nice dollop of net exports that we can see up here. We've got the green, which is government spending, so there's a nice dollop of growth coming from there from recent defence spending. This is our household consumption. This negative growth, detracting from growth, is, of course, business investment. Now, the point about this is that if we looked at the Q1 GDP numbers, big driver there was LNG. There are a number of platforms coming online through this year and next year, which will just boost the volume output of LNG in Australia. It will surpass Qatar as the largest exporter. And these will simply just magnify the GDP numbers going forward, probably for the next year and a half to 2 years. One concern we have at the NAB is what happens after that. When those numbers, the output will still be there, but in terms of annual GDP change, they will not be there. And therefore, GDP needs something else to drive it going forwards. Now, we're hoping that the business investment drag on growth, which the RBA thinks is at its peak now in terms of the cliff, the destruction that it's doing to the economy, is at its peak now and probably will run at that level for another year. So it's possible that as we go through to the next 2 years or so, those two things come together. But we've just got a question mark about where is growth coming from if we're not going to have that growth, the changing growth that's coming through from the net exports and LNG. Of course, talking about all this LNG and commodities, we can look at the budget situation in Australia, and we know that over the last few years, even though Australia is ramping up its LNG production, its iron ore exports to China continue to be almost at record levels. What it's getting for these resources has been hit, and this has hit Australia's receipts, and we can see that with this dip here. Now, the budget recently was commended by the ratings agencies in terms of the commitment to get back towards balance, but you'll notice that Moody's said the budget projects somewhat wider deficits than expected last year, continuing a succession of revisions over the past 5 years. And this is the thing that's getting at the ratings agencies, this kind of every year pushing back when we're going to get back to balance. And of course, this move back to balance is based on those receipts, the hit that we're getting from commodity prices, which are variable, not getting any worse, in fact, getting better. And I think the government has been basing its figures on iron ore and oil prices around about $55, whereas S&P, which has been more sanguine, thinks that prices might go down to 40, and this may well have an impact on receipts, as will growth. Spending needs to be controlled. This is one of the other areas that Australia has struggled with recently, but at least things seem to be, with the upcoming election, the ratings agencies are watching carefully, and that ought to keep a kind of a steady hand on the tiller. This is the government debt situation. Government debt now rising up towards 20%, but not quite there. The ratings agencies, Fitch was straight out and, saying, well, that's fine, you can keep your AAA rating. Moody's was a bit slower, but agrees. It says the economy is vulnerable to shocks on this side. It's watching, but for the moment, no downgrade. S&P has been much more sanguine. Normally, S&P comes out very quickly and reaffirms the AAA. It now wants to wait until the election is over and to see what happens there. We looked at that net debt chart earlier on, slide 2, which showed against its international comparisons, Australia's well placed, with 20% of GDP in debt terms, and that's fine. But S&P in its methodology suggests that if we get up towards 30%, that's kind of the threshold for a AAA economy. Now, you can counter that by saying, well, Australia's got flexibility. Interest rates are still 1.75%. They can cut rates further if they wanted to. The exchange rate will be a useful buffer if commodity prices were to fall. There's a very good relationship in the terms of trade, where as those commodity prices come lower, the Australian dollar comes lower. So it's a self-correcting mechanism in some way, and it will act as a buffer. But the ratings agencies are just watching over, and it's something that we need to keep mindful of. Just very quickly, because Chris is going to talk about this in much more detail, looking at the housing market, we know that the regulatory measures are coming through and seem to be weighing down on prices and on capacity. We know that dwelling approvals here have shot up over the last couple of years or so, just turning over now. And I guess this is all coming together quite nicely. The blip up that we can see at the end here arguably comes on the back of the RBA cut. But, if you take my argument earlier on, in our view, the RBA is not signalling at the moment an intention to ease further on. So maybe that's of limited support. And we would note a recent RBA report where it talks about whatever happens in the short term. It's making comments to the tone of it's quite happy with the way the macro-prudential models or measures seem to be working through, the way that banks are limiting their lending to some sectors. And it's also saying that longer-term buyers seem to be less, motivated by, they have longer-term ambitions. They're not really worried about the short-term swings. We shall see. And I would just note that as this dwelling approval starts to come off, that implies down the track less of a pipeline. So, maybe there's something to think about there. The election, not a lot one can say about it really. It's going to be a very close run affair. There is really no historical precedent that suggests election changes have big impacts on financial markets. We'll have to wait and see. And as I think, whatever happens, the closeness in the Senate suggests any radical policies may never see the light of day. And with the ratings agencies sitting watching very closely, that should also, I guess, keep things pretty tight on that respect. So just to sum up then, we've got a non-mining economy that's travelling well, in respect, given all the headwinds it's facing. We've got a strong labour market. We've got business surveys looking strong, back above long-term averages. We've got a little bit of concern, a strong labour market. We've got a bit of concern about what happens to longer-term growth as LNG starts to come off of its peak. And you might add into that a bit of concern about if the housing market is not the driver that it has been. Again, is this something else we need to be looking at? There's a long way to travel between then. Ratings risks are there, they're present, and of course the uncertainty from the election. I apologise, I've run through a lot of information there very quickly. Happy to talk about this with you in your own time. Chris?
Thanks very much, Gavin. That was a very clear and comprehensive summary of economic conditions and the outlook in Australia. I'm now going to move on to a few slides that Ken Hatton from NAB in Sydney put together just to comment on what's happening with the residential property markets. I think the analysis and commentary on the Australian residential property markets is very frequent and very robust, both in sort of the Australian context, but also I think global investors pay close attention to what's going on. One of the key points I sort of make when I'm talking to people, particularly outside of Australia, is that when you look at the Australian property market, you probably need to look at the various regional markets. I think you can look at sort of overall aggregate figures, but you're not seeing the same movements in all markets. So it is important to see what's going on in the various state and capital city markets. And sometimes when I listen to commentators and talk about sort of the property markets, particularly in Sydney, you could almost substitute Auckland and Vancouver, because when you listen to commentary around what's been happening in those markets, it has a great degree of similarity in the sort of commentary being made. But this first graph, it's showing what's happening overall, and it sort of, I guess, describes at least buoyant conditions in the Australian property markets. And, with the analysis from NAB, they're showing that overall capital city prices are up 37% in this particular growth cycle that started in 2012, and markets are up 27% from previous peaks. So whether you call that, buoyant, healthy, a bubble, they're the numbers. But as I say, you've got Sydney in this growth cycle up 50%, but Perth down 7%. So it's not sort of a uniform picture. And as the slide notes, the key things driving the current situation are the historic low interest rates in Australia that flow through to mortgage rates, increased foreign demand in recent years, and what's been sort of a reasonably long-standing imbalance between supply and demand, although, as Gavin was sort of indicating, with recent dwelling approvals, that imbalance has started to be reduced. So I think, again, for an international audience, the key thing to sort of remember about Australia's property markets, the overall aggregates are dominated by what's happening in Sydney and Melbourne, the largest cities in terms of population and obviously property activity, and they're the largest and most liquid markets. And what NAB is showing in this sort of busy chart is that they're seeing a moderated level of growth for the markets in 2016. One of the things that's focused on, particularly in Australia, is, I guess, the deteriorating affordability of housing for some sections of the market, and everybody, and politicians included, focus on first home buyers. And this is just showing that, again, sort of prices have moved both in terms of percentage of GDP and as a percentage of average full-time earnings above 10-year averages. But I suspect that this largely reflects that we do have very low interest rates and mortgage rates, and that there is, strong demand for housing. And particularly, I guess, over the last decade, you could say that the degree of household formation in Australia has slowed. And so with any opportunity to sort of borrow to get into the housing market, sort of people wanting to sort of form new households, take those opportunities. But as we'll probably hear from the panel that will follow, there's been a lot of activity around lending in the housing market, and sort of what I'd call jawboning coming from the likes of APRA and ASIC and others. So this, again, is just looking at sort of a factor that a lot of people look at, again, particularly offshore, about the indebtedness of the Australian households. And what it's indicating in that sort of left-hand graph in the sort of grey line is that total household debt to disposable income is relatively stable sort of since 2005, 2006. But overall indebtedness has ticked up. And I guess what NAB is saying is that they're not seeing sort of a potential further breakout in this growth in overall indebtedness. And the right-hand, the left-hand chart is also showing that owner-occupied debt is steady. So what's probably been going on is that indebtedness has increased as a result of investors in the market sort of borrowing to get into investments. And for many, particularly those that have self-managed superannuation or pension funds in Australia with low sort of deposit rates and volatility in equity markets, the attractiveness of investment in real property has continued. But I think the takeaway from this slide is that obviously with the majority of the market borrowing on a variable mortgage rate basis, that there is certainly risks that any increase in interest rates pose some risks for borrowers and lenders. And in terms of the demand and supply equation, as Gavin pointed out in his presentation, that there is growth in both the labour market, but overall sort of growth in Australia in terms of population, somewhat driven by migration. And this is certainly influencing what's going on in terms of the demand for property and sort of the response from developers in terms of the supply. When people look at Australia, probably if they're not so familiar, they're probably surprised that such a large land mass can have such a concentration of population in very few cities. It's a highly urbanised market, and that's sort of unlikely to change anytime soon. And a sector of the market that, again, gets a lot of commentary and focus is what's happening in the apartments market. And that seems to be driven as much by sort of foreign buyers in that segment, because that's one of the markets that they can fairly freely participate under foreign investment rules, that new properties are a type of asset that foreign buyers can purchase. And the other thing to notice is that whilst we're highly urbanised as a nation, the density of population within the cities is relatively low. For those that have been to our markets, probably more so outside of Sydney, most Australians like their quarter-acre block, freestanding home. But I think sort of the population and governments are realising there's limits to how far city and infrastructure can spread. And so a number of the centres, particularly Melbourne and probably Brisbane, are starting to see more apartments developments in the inner city, which is increasing population density rates. And another topic has been sort of the influence of foreign buyers in the Australian market. And these are some slides that NAB put together based on information from the Foreign Investment Review Board that needs to approve foreign purchases of Australian assets, certain assets. And as you can see with the left-hand graph, the increase in applications in the 2014-15 year, the most recent reported year, show a substantial increase, and quite a significant proportion of that relates to residential property. And of those applications, it probably wouldn't surprise you based on, again, what Gavin indicated in his slides in terms of tourism education coming from China, that China is the largest country from where applications come. In that 2014-15 year, there was something like $24 billion worth of applications for real estate, and the next largest country of origin for applications was the US at 7 million. So there's quite a distance between first and second in terms of who's got interest in Australian property. And sort of drilling into it a little bit further, what's interesting is, what types of property the foreigners are buying. And probably just to point out in that top left-hand graph that, for the total purchases by foreign investors, over half of them are in apartments. And again, it's over a short period of time showing some sort of stability in terms of the trend there. And looking at the price points, the great majority of what's bought is below the sort of $1 million mark, with 31% at least of purchases for apartments that are less than 500,000. So in many cases, they're probably one at the maximum two-bedroom type apartments in Australian cities, and then 40% in the 500 to 1 million category, and they're probably two to possibly three-bedroom apartments. And these are a couple of slides which sort of show the what's happening with the banks in terms of their exposure to residential property. Again, it's a topic particularly for investors in bank bonds. And what this is showing that there's again a slowing of the investment lending for the equivalent of buy-to-let type properties. And whilst there's been some increased indebtedness overall, what people need to look at is what borrowers are doing with offset accounts, and they continue to be popular. And when you're looking at sort of overall sort of indebtedness, it's probably prudent to take into account monies that are sitting in offset accounts, which reduce the interest cost for borrowers, even though they may be borrowing a great amount of money to get into the market. And the final slide, just to comment before we hand over to the next panel, is that when you look at this, that again, there seems to be some stability and consistency in the overall banking system's exposure to owner-occupied loans, that solid black line. After sort of falling away a little bit, that's kicked back up to what you could consider to be a sort of medium-term average of around 70%. And the investment loans, which is the solid red line, has shown a sort of a bit of a dip over the last 12 months, and I think that points to the impact of sort of macro-prudential policies and sort of some what I describe as private jawboning of the banks from the likes of APRA and others in the regulatory sphere. So that's a quick sort of set of comments around the housing market in Australia. And I think both what Gavin has put out and those that information that Ken Hatton has put together probably lead nicely into the panel that I'd like to welcome Jacqui Fox from NAB, the Head of Securitisation and Investment Grade Origination, to come to the podium and introduce her panel to talk about what's going on in the RMBS market in Australia. Thank you.
Thank you, Chris. Just wait for the panel members to pop up. And warn them not to, the end persons, not to wriggle on your seats, because I can see you're sitting very close to the edge there. So just to introduce the panel, we have Neil Caulder from EBRD on the far end, followed by Peter Casey, who is the Deputy Treasurer of ING Bank, Mary Ploughman from Resimac, who's Executive Director of Securitisation and recently appointed to the Resimac board. We have Liam Carden from Commonwealth Bank in their funding area located here in London, and Gwenneth, always go to call Gwenneth Paltrow, but Gwenneth O'Shea from AMP Bank, who heads up the securitisation area for AMP Bank. Welcome, everybody. I hope you're not too jet-lagged for the travellers. I think we'll just kick off with a brief snapshot. This has been a lot of material that both Gavin and Chris have gone through this morning. So in terms of, I guess, RMBS issuance, we heard from the introductory this morning that the Australian RMBS market has actually been a very significant contributor in terms of supply. The charts are obviously quite self-explanatory up there, but 2016 has been a little bit quieter in terms of kicking off. Really, that's centred on the volatility that we experienced in Q1. So we did take a little bit to kick off, and then there's been a few issuances since then, with NAB's recent deal last week being a $2 billion deal. At the moment, we've had contribution in terms of sectors from all sectors other than the other ADI sector, which is really what we refer to as the credit union and building society sector. They're yet to come to market this calendar year, but we would expect them to be looking at coming in the next 5 or so months. But as we can see there, the major banks have been a large contributor, but also the non-ADIs have been a significant contributor as well, both across prime and non-conforming RMBS. So a little bit of supply there on the non-conforming side, which in Australia we do have a good steady contribution from the non-conforming RMBS sector. Just some metrics here. This material will be available, so just in the interest of time, I won't spend too long on it, apart from just pointing out some key statistics there for the interests of the audience here. Really what we've seen is the seasoning quality of the collateral is quite high there in terms of weighted average seasoning from loans securitised at 56 odd months. And on the prime side, particularly I think with the contribution of the major bank assets as well, we tend to see that sort of reflect the broader market. But interestingly, on the non-conforming side as well, we also see quite healthy seasoning in the underlying collateral. In terms of interest-only and investor-type asset collateral, not a huge differentiator, the same obviously with owner-occupied. On the full documentation side is probably a differentiator there with the non-conforming product in Australia allowing for self-certification, albeit with pretty stringent underwriting criteria associated with that, which we can touch on later. Just a little bit of a breakdown here in terms of, I guess, the segmentation in the market on the prime side, which we'll leave you to ponder that. What I would say is generally speaking, quite similar collateral statistics though across the various issuing segments, which I think is probably a good, healthy thing for offshore investors, knowing that in terms of the different issuers that come to market. I think in the main, they are all contributing reasonably consistent collateral to the broader issuance profile. Again, a few statistics here for interest, but I'll skip over those because the material will be available, and have a look at some arrears charts. This is available from Standard & Poor's quarterly released, and our most recent release, which came out last week, is reflected in these numbers for quarter end March. So arrears tracking very well, upticked a couple of basis points, but still quite low averages. And I think the important thing to note there in that chart is the pretty stable denominator in terms of that calculation as well. So that's not masking, if you like, anything for that. This is a breakdown in arrears performance by the segmentation by issuers. I think probably the key thing I'd really like to point out here is in the non-bank sector, where we've really seen arrears come down over the last few years, which is reflective, I guess, with the opportunities that they've created for themselves in terms of the way they access the mortgage collateral in the Australian market from the origination perspective. So as an industry, we're very pleased to see the performance of the non-bank sector performing so well. This is some cumulative gross loss by total issuance by year of issuance, and I think probably the important thing to note there in the 2010 issuance year as opposed to origination year, that probably reflects collateral of the 2008 type era, which is why you see that having performed at a much higher level. There's some information here on the non-conforming side. I'm wondering what Mary Ploughman is giggling there on the panel. The non-conforming arrears performance has actually been quite good as well. Although the denominator has been rising, still it has been performing very well in terms of arrears performance over time. So we keep a close eye on that, given that there's a lot of supply that comes to market in the non-conforming sector. I won't add any commentary here, all self-explanatory. And I just thought for the audience we would include a little bit of information here on just the investor breakdown in terms of what we see in terms of the deals. So this information's been sourced by NAB, and we've really combined the investor location of all the various books of the deals that we've brought to market. The stats are pretty self-explanatory, but what we have seen here is some good participation from European investors, including some sitting here in the audience. And increasingly, we're seeing a bid coming out of Japan. But also we have our New Zealand counterparts across the water that are a regular buyer into the Australian RMBS transactions. For the US deals, we have US investors that will buy in both Aussie dollars, but also in terms of some of the 144A deals we take to market, which have tended to be either shorter duration or scheduled AM type transactions of around a 2-year duration. In terms of pricing, we obviously had the market a little bit volatile, but what we've shown here is it tracked against the 5-year senior unsecured major bank spread levels, which tends to track fairly closely historically with the 3-year major bank RMBS weighted average life transactions. But you'll see pretty much like in 2016 that gap's widened, which might imply there's some good relative value there on the RMBS side. Our expectation would be that will track that back down a little bit closer as it has done over time. So we'll head over to our panel. Thank you, panellists. I might actually kick off with Peter and Gwenneth. And we heard Chris mention some of the, I guess, key regulatory changes we've experienced really over the last 12 to 18 months. And as authorised deposit-taking institutions, I was hoping you could share with the audience your perspectives on those changes and what influences they may have had.
Okay, thanks. I think there's probably two aspects to it. So first of all, there's our role as a lender. So we've had APRA come out and make some changes there, which I'll work through, and also our role as an issuer of RMBS. So to that extent, there's been some changes to the holdings that of liquid assets that the banks can have. So firstly, as a lender, I think the clearest example was the 10% per annum growth cap on investor loans, which APRA has put in place, and that's clearly had an impact. So you can see a number of lenders who were growing at above that level have pulled back over time, and that's been through a mix of pricing action and lending standards. And secondly, more broadly, APRA undertook a view of lending standards about 18 months ago, and that resulted in then coming back to all the ADIs and reinforcing the standards which they would expect. They undertook what you might call almost a mystery shopper exercise. So they gave to a number of the larger ADIs a set of financials from borrowers that might come to that lender, and it was standardised across the industry, and then asked each lender to come back and say how much money they would lend to that sample borrower. And there was a handful of samples there. I think it gave each lender a reality check of where they sat in the market, and if they were standing out as a lender who was overly generous, then APRA would require that lender to review their policy. So there was a hard cap on the investor loan growth, and there was some sort of softer approach on requesting lenders to go back and review their serviceability standards. Secondly, the impact as an issuer of RMBS is that we have the Committed Liquidity Facility in Australia, the CLF, and that's basically because there's not enough government bonds in Australia on issue that ADIs can hold RMBS amongst other asset classes under this committed facility. As those facility sizes have reduced, and there's been a reduced demand for RMBS from the major bank balance sheets. I'll just put a chart together there. What we've seen is, while there's still demand, it has been somewhat reduced. So we've been certainly noticing over the past few deals on the chart on the left-hand side, the banks are the orange, and you can see they've been declining over time, replaced somewhat with money from funds and agencies. And you can see maybe more clearly on the right-hand chart where we've had a growth in demand from offshore investors. So obviously no two deals are taking place in the same market, but you can see, I think, reasonably clearly over time that there's been increased demand from offshore, and that's been replacing some of the demand that's fallen away from the major bank balance sheets in Australia.
Thanks, Pete. Gwenneth, did you want to add to anything on that?
Yes, I agree with Peter's comments, and I think from AMP Bank's point of view, we were one of the most, took one of the drastic actions and actually withdrew from the investment lending market completely towards the end of last year, just to manage that growth and be under that growth rates. And just want to make it clear that APRA's actions weren't driven by credit, so there was no change in the credit performance of the investment product. It was all to do with managing the demand for the housing product and managing the pressures on the housing market. So, and Peter mentioned about APRA coming in and doing lending standards. It's just another way of them managing demand and price movements in the housing market. So, and for us, the knock-on impact is we did see some slippage in owner-occupied, because normally what happens in a person's life cycle, somebody gets their own home property for their own place to live first, and then as they build wealth and get into that type of phase in life, then they will start to get an investment lending. And if you take out that investment lending, there is some knock-on effect to own-occupy. So it definitely had an impact on the bank's growth for the last 6 months, that action.
Thanks, Gwenneth. And Mary, I might flip over to you now as a MBFI issuer in terms of whether those changes have influenced Resimac's business and whether they represent challenges or opportunities.
Thanks, Jack. Well, interestingly, ASIC was, it was funny when we started, having the conversation about what we were going to talk about, I couldn't think of specific focus other than what had happened for the banks. But in fact, it was really because when I dug into it in the office, it had actually been ASIC had looked at the non-bank sector first, and that started in 2013. So it was quite a few years before, and I sort of hadn't remembered exactly what had been done. But they actually did look at underwriting standards of the non-banks and picked 16 participants in the market and reviewed the standards. They focused on actually LODOC in the first instance. They also looked at the work that was done in terms of understanding the way people's living standards were looked at, and the result of all that was a more conservative environment that was undertaken by the non-banks. I think to Gwenneth's point, which I'd also really impress upon everyone, is that it wasn't a function of the performance of the underlying collateral. That the actual underlying collateral in the non-bank sector, as well as the banking community, was continuing to perform well. I think it has resulted in probably greater conservatism in all sectors. I think the non-banks are sourcing from different areas. That's related in improved performance, but there's also been those few things where basically much bigger focus on how people provide information about how they can service loans, information about that you can't use just a benchmark to determine whether people will be able to service what their living expenses are. There's also a focus on, with an investor loan, that you actually the 5-year interest only cannot be included into the P&I calculation. So there've been a few very specific changes that they've looked to. I think the result has been there is a reasonably level playing field in underwriting standards across banks and non-banks. I think the interesting thing on the opportunity side is that with the hard cap of investor lending, that has created a bit of an opportunity from our perspective. But of course, we're funding ourselves using warehousing, which means that that can still cause concerns around how much can go into investor lending. Again, we haven't had any concerns around performance. But I think that the good news from our perspective is that because we are actually quite a nimble organisation, being small, if things change, we can move quite quickly, and we can actually take advantage where those opportunities open up. I think that one area that hasn't been spoken about yet, and I just completely agree with Peter's comments around bank balance sheets, not that they were big buyers of our paper in any event, but the fact that they're not there in the market has impacted the amount of liquidity in the RMBS market. And I think that's probably one of the reasons for the gapping out against the 5-year mark that you were talking about before, the fact that there are less buyers. I think as others come into the market, that will stabilise. One thing that we have possibly seen is that we probably have felt the banks have pulled back on the amount of lending they're doing, and whether that's because of APRA guidelines, whether it's the concern around coming down the pipe around the amount of capital that needs to be put around mortgages and the way they're valuing it. I think where we see that as an opportunity is much more to a level playing field. We obviously have a higher cost of funds, but because our capital requirements are lower, it allows us to compete more readily in the market, and I think that's meant to pick up in market share from our perspective without having to drive pricing down or underwriting standards. So all those things have worked well for us. I think generally it's a good thing in the, and I'm going to say this, but it's a good thing in the mortgage market generally for Australian consumers, because you don't have that massive dominance of just 4 players. There is a much more spread market. There's more people coming into the market, and I think ultimately that's good from everybody's perspective, certainly from ours.
Thanks, Mary. And just to pick up on a couple of things that Mary said. So the change to the risk-weighted asset treatment of the residential mortgage loans from the major banks will move from circa 15% risk-weighted asset treatment to about 25%. Hence, there'll be more capital applied to those residential loans. And in terms of the committed liquidity facility and the bank, investment for that, it's important to note they're still buying. It's just in the last couple of years they were more in accumulation phase with a CPR of about 20% roughly per annum. You would expect to see the bank balance sheet still bidding in the transactions, but perhaps not to the same quantum that they were during the accumulation phase. Neil, EBRD's been a pretty active buyer in Australian RMBS over many years. Thank you. Perhaps if I could just ask you what attracts you to the product, and in terms of some of the regulatory changes that the panel have mentioned to date, how you've seen that and what your core areas of focus are.
Very good, thank you. Really the story of EBRD investment in Australian RMBS has 2 phases. We were investors in the mid-2005-2006 period, and that was in both bank and in non-bank RMBS. That effectively rolled off really in, I suppose, 2013, 2014, at which point we had a look again at the market. And really for us, the aspects that struck us was an investment in Australian RMBS gave us access to a growing, robust, open economy. Obviously, at that time, when we first started to reinvest, which was at the end of 2013, beginning of 2014, we were still very much in the grips of the mining story, and there were various commentators that were suggesting you were taking a AAA play on the China story. Well, we always saw a little bit more in Australia than that, you'll be pleased to know, which means that we have continued to invest really through the whole of that period from the end of 2013 onwards. Notwithstanding that, the robust growth story, there is also the element of what we've touched on, and that is it's a well-regulated market. The APRA, ASIC's interventions in terms of macroprudential measures give us confidence as investors from a long way away that actually people have got a close eye on the market and the potential negative evolutions that can take place if certain measures are allowed to continue the way that they are. We've also really, over that period, going back to 2005, 2006, always been impressed by the relative transparency in the market. We've always had access to monthly reporting. The quality of the data and the reliability in general has been good, and in fact that's continued to the present day. There's also the sense that it's a well-covered market, both from a macro level, but also at the securitisation level. There are several ratings agencies, and particularly the large bank research houses, are giving us a really close view of what's going on in the market, and we feel that we have a familiarity with some of the micro elements of going on over the course of our holding of a product. And it is one of the things with the Australians and their obsession with property. There's never a time when there isn't a crisis going on somewhere, and whether it's Perth and Western Australia at the moment, or at other times it's been southern Queensland, we always feel that, we're aware there aren't any kind of secrets out there, which gives us confidence that in terms of issuance and the loans that find their way into the securitisations, people are taking note of the underlying aspects of the good and bad parts of the underwriting. We're also looking at aspects that over the course of time have worked for us and haven't worked for us. We've invested in a large number of deals over time. One of the things we are looking at and always aware of, and it has been touched on, and that's the relative liquidity in the market. The reliance on Australia for offshore investment has meant that at times the liquidity offshore hasn't always been as robust as it might have been. And so that, to a certain degree, informs our investment strategy. So we're tending to look at, over time, those investor platforms for us that are likely to be able to continue to issue both through good times and bad. And in fact, one of the elements in our second phase of investment that to a certain degree gives us confidence from that respect has been that we're investing almost totally in Australian dollars. This has given us advantages in terms of access, and if there is a weakness at times, it's the fact that availability of the product more widely is hindered by the currency and the difficulty of getting cross-currency swaps in the present environment. This is being addressed, and again, this is one of the elements that gives us confidence in the market, in that there is now through APS 120 the capacity ultimately to create master trusts, to have date-based calls, which makes the creation of a non-Aussie dollar product more easy to achieve at an economic level. And I can certainly see us investing in US dollar or euro-denominated Australian RMBS in the same way that we invest in non-Aussie dollar covered bonds from the Australian market. I think to a certain degree I've probably touched on those elements, but there is one final element, and that is pricing for Australian RMBS given the relative credit quality, and that consistency of credit quality over time is presently very attractive. There's not too many other markets where we are in three-figure basis point returns, and certainly for the time being this will drive our investment strategy. And what it has also meant is that when we first came back into the market, our spread hurdles meant that we were looking at non-bank financials. It has meant that with the overall increase in spreads, it's meant that for the time being, we have been able to focus more on bank issuers. But that doesn't mean by any stretch of the imagination that as spreads even out and come back in again, we won't be re-examining the offerings from the non-bank sector.
Thank you, Neil. Liam, from CBA's perspective, be interesting if you've got anything else to add for the audience, and perhaps in terms of being an issuer, how you look at various things in terms of various funding tools to determine what RMBS might add from CBA's perspective.
So from CBA's perspective, RMBS is an important source of wholesale funding. We do 2 medallion deals a year. We're quite programmatic in our approach to the market. The nature of RMBS generates incremental investor demand from investors who already hold us in senior or covered, and the additional investors who buy RMBS only. We look at trades in context of how they fit into our LCR metrics that we have to meet, and from January 2018, our NSFR hurdles that we'll have to meet. But also we're looking at transactions in terms of home loan risk weights. As you mentioned, APRA's increased those, and whether or not it makes sense to undertake capital relief RMBS. But whilst that's possible for us at the moment, the margin on the subordinated notes remains too high to justify it, but it is something that we always look at.
Thanks, Liam. Pete, we might head back over to you. Just in terms of the, I guess, solid credit quality and arrears performance, whilst we've got recognising, obviously, that unemployment's low and interest rates are at historically low levels as well, what are some of the key underwriting strengths you see in terms of the residential loan market that help support that performance?
I think one of the keys, especially for us, is around the serviceability measure. So, as highlighted by APRA following their review of lending standards, the importance of having a floor rate when you're assessing interest rates. So, while a customer might be able to borrow at 4% now, you really want to be able to make sure that they can meet a 7 or 8% rate if and when that returns. And you know, that might be a number of years away before that actually happens, but we think it does cover a lot of additional things that might go wrong, whether it's a reduction in income or an increase in other living expenses. So for us, that's a key, and it's been recognised by APRA. Documentation, look, it's a focus ongoing through the industry. I think it is a strength of the industry. Generally, we're writing full doc loans, and there's verification of income statements and bank account records as well. So I think it's another strength. LVR restrictions. So we have, and as all lenders will have, pretty tight risk appetite statement through to the board level. That goes to APRA. We track that every month and report back to APRA. So it's not just the fact that we have these measures in place, but they're quite visible all the way through internal and external framework. I think finally the collections culture is quite strong in Australia, so it's supported by the legal arrangement, obviously full recourse lending, and while there's good consumer protection in place, it's a good balance between what the banks can do, and I think there's a slide that Gwenneth put together, but generally the banks all lenders are following a pretty well-worn path that has been effectively accepted by the courts and the regulators.
Yeah, that's right. Thanks, Pete. Mary, as a lender that offers both prime and non-conforming products, perhaps if you can touch on some of the key underwriting differences between your prime and non-conforming sets and any performance variances and Resimac's approach to pricing for that risk differential.
So in terms of underwriting standard and what is applied for a prime or a non-conforming loan, it actually doesn't differ. It's the same standard, the same level of scrutiny. The difference with a non-conforming is the type of borrower. So the sort of borrower that would be looking for a non-conforming loan would be somebody who would not fit into the very tight framework of a prime borrower, and therefore the type of information they would provide as you go through that underwriting process would be different. So it might be that they would be, historically have been referred to as a low-doc borrower. Interestingly, they probably provide more documentation than the prime borrower in order to justify their income, but it is somebody who is probably self-employed and can't just hand over a payroll slip. But we do an extensive amount of investigation about their ability to meet their criteria, that meet their servicing, but it is a different and ostensibly higher risk style borrower. The issue on the security side, however, is probably the reverse. It's a lower risk that we would take on security. So the LTVs that we would look to in a non-conforming environment are lower. So therefore, we would argue that we might take more risk on a borrower but less risk on a security. I think the overriding thing is the way we manage them as well. It's a much more hands-on approach, and we do need to work with them sometimes if they have variable cash flows, and that involves, I think Peter alluded to it, we do have in Australia a very proactive approach to arrears management, and we're allowed to in the court environment that we have, so that we're able to do that and work well. The result is that the performance in the non-conforming space, not just for Resimac, but for others in our space, is still pretty attractive. And as Jacqui referred to, we can actually charge more. So because they are a high-risk borrower, we're able to, it's not so finely priced, there's more flexibility. We can actually incorporate risk fees to address that risk as well. And the result of that is, from a risk-return perspective, actually, they would certainly in a strong property market actually look like it looks very strong from our perspective. And also, we don't have the side where we're competing so heavily. It's a smaller market, but we're not competing so heavily with the major banks. So it's a very good part of our business, and it's grown strongly over the last few years. Obviously, we're very aware that the economic environment is working very well in our favour because we've got full employment, strong economy. So we work very closely to actually assess the risk profile of that book. But yes, it has very stringent underwriting, just different style of borrower.
Thank you, Mary. Gwenneth, we've heard both Peter and Mary touch on collections, but perhaps if we can go to you to just run through our standardised collection process in Australia. And really, in doing that as well, how does a lender like AMP Bank, for example, take the insights that you're garnering in terms of arrears performance and bring that back into the, underwriting standards or risk appetite of the bank?
So I think, firstly, the one of the unique features in the Australian market is it's actually up to the lender to prove that it has all the documentation and made the assessments for that borrower to obtain that loan. So what that means is that it's not on the onus of the borrower to prove that he's got the money to lend. It's actually up to the lender to prove that that borrower could afford the loan in the first place. So, and that's the same across the whole market. And that then flows on to the arrears process. There's a standardised, pretty much a standardised process as to, at what point you can contact the borrower, the hours per day that you can contact the borrower, how you can contact the borrower, at what point do you then move, say, to the final notices, legal notices, in actually obtaining that security property for sale, and when you can then go on to sell that property. So it's all governed under the National Credit Code, along with the ability of the lender to prove that that borrower could actually afford the loan in the first place. So I think the key thing is, under the process, and one of the factors driving the loss performance is make sure you get in touch with that borrower early in the process rather than later. And that involves phone calls, sending SMSs, and just generally contacting people, whether it be, I think we're allowed to contact them up until 8 o'clock at night. So thinking about outside of the 9 to 5 type arrangement, getting in touch with them in the evening and working out an arrangement with that borrower. And the next thing is, once you've got customers in arrears or lost performance, is then using that data and the behaviour to drive your underlying underwriting standards, whether or not you've got certain postcodes or certain areas that have higher arrears numbers versus other areas. What's the value of the property doing in that particular area? because the borrower has to be in default before they can actually, get in a position of loss. So if you can manage the default performance first, and then the likelihood of the loss is minimised. But that definitely goes through, I think everyone's got their credit committees, and all that analysis goes up to the credit committees, and it's talked about on a regular basis, especially now what we're seeing in WA and the mining sector, Queensland, and the impact that that's having on arrears numbers, and then the property prices and your position of loss.
Thanks, Gwenneth. I think, Neil, you touched on the transparency of data, and I think with inside all of the lenders, that's obviously a great attribute as well, which closes the whole feedback loop back into the underwriting standards. So just taking it one step further, how do the underwriting and collection standards of the Australian RMBS market compare regionally to other jurisdictions?
What I think has been fairly true over the years has been that consistency of underwriting across different issuers, which points to a well-understood process of what is required to both service a mortgage and ultimately to collect upon it. This really, I suppose, comes about when we do visits to the servicing platforms, as I have done over the years on 4 different continents. And one of the things that always strikes me is that just how similar they are, and how similar the experience is in terms of how the office looks, what's on display, the people that you're talking to, wherever you are in the world, until you go to one where something isn't quite right, and then it stands out like a sore thumb. And it is a certain degree of comfort that when you visit the services centre, there's the same process charts on the wall, so everybody walking past knows what you have to do after 30 days, 60 days, knows the process of the letters. But that's always backed up with people wanting to explain in a lot of detail the high degree of automation in the whole process and monitoring. People are enthused about this, and they talk about how the fact that once it's gone into the process and been identified as at risk, there's a whole process that takes over, which is very difficult to deviate from, and it comes up with a high degree of probability of the outcome that's expected. The use of a range of communication skills is something that we've seen has been particularly effective over the years. And you mentioned the text messaging. It just seems to work. It does the trick. But there are other elements as well when you're walking around the servicing centres. It's the amount of people. It's a fairly labour-intensive business. You expect to see a lot of people there. You also expect to see them organised into teams, and there's always a big team culture thing going on with competitions. And that whole element of the way that the process is monitored and made available for everybody to see in terms of promised collections, particularly in a specialised and a more difficult circumstance, promised collections versus actual collections. And that's something that I always ask about and very interested in, because anybody can be fobbed off with a $10 a week repayment plan, but if they're not even going to keep to that in the short term, it doesn't offer up too much prospect in the longer term for an ultimate repayment and getting back on track. Also, there is the element as well of the way that technology has become more and more important in terms of the collection process. And Australia, in having such a long track record, means that there is a wealth of data that can be used in a more predictive way. And that's perhaps one element that I haven't seen perhaps kicking in Australia quite as early as I've seen in perhaps the US and to a certain degree the UK. And the use of that data, I don't know whether it's partly driven by the availability of a wide range of bureau data that in some jurisdictions is more readily available than others, but there are some places where they boast that they know someone's going to miss a mortgage payment 6 months before they do. I wouldn't necessarily say that, from what I've seen, Australia is there yet, but what it makes up with is the ability to, once a payment has been missed, to kick into action with a well-disciplined process that has been proven over time to give the desired result.
Thanks, Neil, and I think you're right, because historically we've been on the negative reporting, but that will change in the future. Liam, in terms of CBA as an issuer, you obviously speak to a range of investors. Have you noticed any commentary around any jurisdictional differentiation between Australia and other areas?
Yeah. I think investors view Australia as on par with global best practices, mostly, and we see this increasingly in the order books with offshore participation in Aussie dollar RMBS. As Neil said, we have efficient originating, underwriting, documentation processes, and the collections process is particularly swift. And I think a lot of issuers and originators, they've had the 08-09 period where there was a little bit of pick-up in arrears to fix up any inefficiencies in the collections process. So they're very efficient now. I mean, CBA's arrears are extremely low at 47 basis points of the book is in 90 plus 90-day arrears. Mortgagee in possession is 600 accounts out of 1.5 million. So the conservative underwriting standards, our serviceability tests, which at CBA we've always had a floor of 7.25%, mean that investors, I think, are happy with the credit.
Thanks, Liam. I think that's probably dealt with most of our questions, and I'm conscious of the time. Just very briefly, in terms of the outlook, from NAB's forecast, we anticipate the market on the RMBS side will close out around 20 billion for calendar year 16, based on our understanding of the pipeline and interactions with issuers. Thank you very much. Thank you, panellists.
Yeah, very good.
Thanks very much, Jacqui and the panel. And we now turn to our final panel of the morning, and this will be moderated by Michael Moloney from Westpac. So I'll invite Michael to the podium, and we hope to conclude around 12:15.
Yeah, it's good, mate. Where were you, buddy? I landed last night. Oh, I don't know. It was really good. It's good fun, yeah. Yeah, no, it's good.
Okay, thanks, Chris. Welcome to the final session of the morning. Firstly, I'd like to welcome our extremely well-credentialed panel. Back home, they're sort of household names, but here maybe not, so I'll ask them to put their name up when I call them out. So first of all, Kevin Lee from Macquarie Bank. We've got Stephen Magan from JP Morgan. We've got Richard Dickie McCarthy from Perpetual Corporate Trust, and Matthew O'Hare from Pepper Group. So, today I'll cover four main topics. Initially, look at the trends for the specialist mortgage, auto and equipment lenders. So with banks and other institutions continuing to review their balance sheet due to changing regulations, we expect to see further acquisition activity in the Australian market. Saying that, in 2016, the ABS issuance volumes have predominantly been auto-backed transactions, pretty much Macquarie and Westpac. However, looking forward to 2017, we really are hopeful that there'll be some more diversified collateral. So I'll put the first question to both Kevin and Stephen, just whether they'd like to make a comment around ABS issuance trends with reference to auto and equipment-backed deals. Maybe Kevin, if you'd like to fire away.
Sure, Michael. I think in the ABS space, the backdrop is quite positive. This year to date, we've seen 5 ABS deals, which is on track to the same as last year. I think about 3.4 billion of issuance. And that's notwithstanding, obviously, the extreme volatility in global markets that we saw at the beginning of the year when there's a lot of disruption. So that's actually very encouraging, the fact that we're still seeing the steady supply of ABS coming out of Australia, notwithstanding that volatility. Why is that? I think there's a couple of key factors. Firstly, from a collateral perspective, you mentioned that autos dominates the Australian ABS space. I think new car registrations in Australia, it's going to be another record year. So that's it's a continuing growing market in Australia. I think in terms of finance in the auto space as well, there's a growing take-up of financing of autos. I saw some stats that, for example, in 2011, there was 40% of new cars were financed, whereas now it's approaching 50%. So there is a kind of a bit of a structural shift happening as well. And underpinning that as well, obviously, as you heard from Gavin earlier, things like the stable economy, low unemployment, low interest rates, they're all positive for the ABS space generally. So I think they're very positive underlying forces for ABS coming out of Australia generally.
Okay. Stephen, do you want to add to?
Yeah, thanks. I think the auto ABS market came out of the financial crisis relatively unscathed. That's helped. And as the chart there shows, since 2009, we've seen fairly steady growth in issuance. So the issuance is really dominated by 2 major players, being Macquarie Leasing on the smart side and Westpac on the Crusade side. When it comes to acquisition activity, I think it's really having 2 different influences. On the one side, we've got Westpac having acquired Capital Finance. It's probably led to less issuance because Westpac take a lot more on the balance sheet. On the other side, the recent acquisition of Macquarie Leasing, picking up the Asander business, which is the ANZ auto origination business, will likely lead to further issuance in the future. In fact, quite substantial further issuance, I expect, in 2016 and 2017 and beyond. So away from the larger players, we continue to see a steady flow of smaller deals from other ABS issuers such as Bank of Queensland, Fleet Partners and Liberty. So we may also see some new entrants coming into this market in the near future as well, which will be a good thing.
Yeah, certainly hope so. So with the another question, I'll keep it to Kevin and Stephen again. Will the non-traditional ABS asset classes, such as operating leases, small business loans, factoring, etc., will they have a place in the Australian ABS markets going forward? Stephen, did you want to have a...
Yeah, I definitely think they will. Firstly, on the demand side, most Australian-based investors are primarily focused on RMBS. However, if the spread is compelling enough, they will do the credit work and get comfortable with the other asset classes. And clearly, the more non-traditional asset classes are going to be more appealing from a spread perspective. On the supply side, Fleet Partners did their first operating lease deal back in 2014, and that deal was very well received. There's another issuer that we're aware of that's considering an operating lease transaction. There'll be a new issuer. So that'll be good to see. We've seen some small SME deals come to market. And with respect to factoring, we've got there's a company known as Scottish Pacific in Australia that's doing their IPO shortly, and they're expected to securitise at some stage as well.
Okay. Kevin, did you want to add anything?
Yeah, look, I agree with Steve. I think those sort of other sort of more esoteric or different classes, you will see more deals. I think, the backdrop in Australia, the traditional lending markets are very mature and very competitive. So we are seeing existing players, whether they're in mortgages or mainstream autos, looking to diversify into new fields for new business opportunities. And over time, that flows through to funding and through the capital markets. So I think that's positive. I think, generally that the backdrop from the investor side, they're always keen for diversification. So that works well. And again, I think, the point I touched on before, the fact that these newer asset classes, there's an opportunity, there's more pricing power from the lending side. So if there's more margin in those products, they're better equipped to sort of come to the securitisation markets, irrespective of market conditions. So I think that's good.
Okay, great. That's good news. Look, we've got with Matthew from Pepper here. It's probably timely that we ask him to comment on trends that you're seeing in the specialist mortgage sector.
Thanks, Michael. Yeah, there's quite a few points I'd just like to highlight and leave you with today in regards to the specialist mortgage sector. So, firstly, it's been touched on a couple of times already with the banks and prudential controls stepping up last year, tightening their lending standards. There's been a flow on to the specialist lending sector. We're in a position to pick up now significant quantity of loans that perhaps the banks previously would have written. So we call that the near prime. So our book is about 45%. So whilst we're a specialist lender and it's traditionally associated with credit impairment, 45% of our book traditionally has had no credit impairment. It's just been those loans that slightly sit outside of the bank criteria. This year we've originated about 70% of our production, and that's an increased volume on last year as well. So that's that opportunity that's come from that APRA intervention into the market last year. Similarly, we've tightened our servicing standards, serviceability assessment, just along with the banks as well. So we took a look at the interest-only criteria. We've always required a serviceability assessed on the basis of the full P&I. But we used to do that for the length of the loan. Now we actually calculate that based on the remaining period after the interest-only period is finished. We've also applied more haircuts now to investment income, rental income from properties in regards to investment loans, and similarly we've upped living expenses as well. So there's been a tightening of the serviceability. One thing that hasn't changed, I think, is the attractive yield pickup that our paper tends to offer over the prime paper. And that, and the other thing as well is the substantial amounts of additional credit enhancement. So we always provide 30%. The market generally in our sector provides 30% CE, when the required CE from the rating agencies is probably somewhere between 15 and 20. So substantial yield pickup, notwithstanding substantial additional credit enhancement. Risk retention too. I think a lot of us are going more to the offshore markets. So we've adopted the full 5% vertical risk retention. That's in order to comply with both the European requirements as well as the US requirements. We can, unlike the banks, offer date-based calls. This sector is traditionally the domain of the non-banks, so they're not inhibited by that date-based call. So we give the investors the certainty on their length of their paper and limit the extension risk. And I think all of it talks to the arrears performance, which has also been touched on. Arrears are down to about 4% for the specialist market, down from a high of 8 to 10 post the 2008 period.
Yeah, no, times are good in that sector. Look, I thought I'd quickly touch on fintech. Us bankers are seeing a lot of inquiry on it at the moment, and I just thought we'd get Steve and Kevin and welcome Dickie, or get you to say something too in regards to whether you see any of these fintech issuers in ABS anytime and soon, or maybe you, Dickie, if you want to have a go.
So we see a fair amount of inquiry, especially from peer-to-peer lenders, but we're not sure that sector is going to pick up as a lender from our point of view. But certainly fintech, in terms of technology companies coming and actually providing services to the industry, we're certainly seeing a lot of companies coming with good product, which I think can actually support the lending industry and in some ways be disruptive as well.
Yeah.
Yeah,
Stephen?
I think we've seen a lot of inquiries as well, so I think that's the common theme. So theoretically, peer-to-peer lending is well suited for securitisation, and clearly it is a growth industry, and we know there's a number of organisations looking to get established in this space. But I think that globally investors are cautiously looking at marketplace lending or peer-to-peer lending for the time being. Rating agencies note that the underwriting has yet to be tested through the cycle. And there's been a lot of negative publicity surrounding Lending Club, and that's really not helpful. There was a recent UK SME peer-to-peer deal that I'm sure people here are probably aware of that only got to BBB- from S&P, so it's likely that similar deals will get the same rating treatment. So I think the bottom line is, if we do see a market emerging in this space, it will come gradually, and people will look at it cautiously over time.
Okay, Kevin, did you have anything to add? Or?
Yeah, look, I think clearly fintech's big story, here in Europe and in the US. In Australia, it's we're a few years behind, but things are starting to pick up. I think last year there were 10 significant sort of equity/funding transactions done by Australian fintech players, 6 in the SME space and 4 in the consumer finance space. That's, whether it's equity investments, mezz funding, or sort of whole loan sales. So not quite to the scale of, full-blown securitisation yet, but clearly that base is being built in Australia. Also interesting is that sort of convergence between sort of established players and the fintech players. So we're seeing people such as Liberty investing in a company called Muller, Flexi Group investing in Kicker Capital. We at Macquarie, we did a small whole loan purchase of loans from direct money. So, it's starting to build that base, and should be interesting over the coming years.
Okay, well, look, we'll move on to some recent innovations in transaction structures, and it's probably worthwhile touching on Flexi Group's recent green note. They did a AAA-rated 50 mil green note, which priced 5 basis points inside an otherwise comparable note. So, will these green notes become a regular feature of the Australian ABS market, Stephen?
I think if Australian originators have the ability to carve out certified green bonds or tranches or notes, then they'd be wise to consider it. Over the last 2 or 3 years, we've seen many funds seeking green deals and a limited amount of supply. So demand appears to be pretty strong. So it seems to me that green bonds will be more prevalent in the future.
And Kevin, I'll throw this one to you. It appears that the inclusion of the green notes allows issuers to achieve a level of price differentiation. Do you want to make a comment on that?
Yeah, look, that Flexi transaction, which had solar panels in the pool, was able to do a green certified tranche at 5 points tighter than the comparable non-green certified AAA tranche, which was kind of pretty interesting. I guess I wouldn't take that as gospel that, it's always going to be the case, that pricing differentiation. I think here in Europe there was a recent Dutch green bond from Obvion, which seemed to go very well, and there's a lot of chatter about 100% allocation to green mandates. So I can see, if you do target green mandate investors, you can get that price tension, but we'll just have to see in Australia whether that keeps going.
Yeah, probably need a few more investors. But look, I'll just comment on a private deal that we saw last year in relation to toll roads and infrastructure. It was a private deal backed by the future income stream on a government toll road. The question to the panel is there sufficient investor demand for these long-dated infrastructure-backed public ABS transactions? I'll start with you, Kevin.
Look, I think, again, potentially, because it's a diversification play, especially if it's things like government sort of related toll roads, etc. That's promising. I think the word of caution around that is, from a government perspective, they look at these deals only if they're sort of non-recourse to the government. So why would they do a securitisation at a higher cost of funds than the government debt, unless they're getting full risk transfer? So as a pure asset-backed play, my understanding is that these deals don't often get to AAA. So again, we're talking about long-dated, potentially non-AAA, but as a yield play, it could be an interesting asset class.
Okay, well, and just one on the specialist mortgage transactions, Matthew. We've seen 4 deals this year in that space, but look, is there anything that any comment around any innovation in any of the specialist mortgage transactions that you'd like to add?
Well, I think innovation is probably a little bit of a stretch, but certainly, what's symptomatic of the specialist market is that we don't necessarily often track much of a bid from the bank sector. So, that means we definitely have to pursue further and wider to find a bid. So hence we go to the offshore markets on a regular basis. And I think the innovative element, I suppose, is more around ensuring that we can structure transactions to meet specific requirements of investors. So We went to the US market this year and have been consistently for a few years now with a 12-month bullet, simply because that sort of attracts the attention and meets a nice pocket of demand in the US. There are other transactions which are scheduled AM. Again, the reason for that is to satisfy investor requirements, that certainty around the WAL, and there are some investors that want to see that bond will be repaid before the call date. So you can achieve that in a scheduled amortisation basis. So I think it's around meeting with investors, asking for their requirements and seeing what we can do to marry up a deal that will deliver on that.
Okay, great. Look, we'll move on to the third topic, being relative value considerations for international investors. I think Neil might have sort of answered part of that a bit earlier around his three-figure pricing margins, which he's liking on the RMBS. But let's move to this one. We've certainly seen in recent years that high-quality ABS from large issuers such as Crusade are pricing inside major bank RMBS benchmarks. And again, I'll put this one to Stephen. Could you make a comment on how international investors are assessing RMBS ABS relative value?
Yeah, sure. I mean, I think firstly, historically, I think Australia was the anomaly. ABS in other jurisdictions tends to price tighter than RMBS as a rule, so we really have to question why it was that ABS was pricing wider in the first place. One thing I think that sort of helped the dynamic recently is Macquarie leasing and going out with the smart deals in the US, and obviously appealing to a large investor base in the US. So they've been going to market since 2010 in that market and have brought in pricing quite significantly tighter in the US market. Now that dynamic's changed in the last 2 years, or last year and a half, let's say, because particularly in the last 6 months, we've seen the US deals gap wider, and most investors in the US are tending toward, the tried and true local issuers such as Toyota and GM, all the strong issuers there. So, what we've now seen in terms of relative value, I think with the ABS makes more sense versus RMBS, and we should expect to see that ABS spreads come in tighter relative to RMBS in the future.
Okay, well, I'll put this one to Kevin. Yeah, there's one of Jacqui's slides showed the 5-year senior unsecured sort of being inside RMBS and ABS pricing. And, Kevin, why, the RMBS, ABS credit spreads are typically slower to adjust. Does this impact the investment decision?
Yeah, look, I think it does. There seems to be kind of a pricing lag from the Australian market between the structured markets and the senior unsecured. So it can create opportunities on a relative value basis. So when we see spreads that are rallying, then the senior unsecured curve will rally faster than the RMBS or ABS curve, and then that opens up an attractive relative value proposition for investors, and vice versa. When it goes the other way, sometimes RMBS, ABS can look expensive if it doesn't spike as quickly as other markets. So one thing we have seen from the investor side in book builds is a slight difference between the Australian investors and the offshore investors. So the impression is that in the Australian market, investors can be a little bit more generalist. So they're looking across senior unsecured, Supras, covered bonds, RMBS, etc. So they're looking at those comparisons, whereas a lot of the players we speak to in Europe, they've got specialist RMBS, ABS mandates, so they're looking at Aussie RMBS relative to other asset classes, but they're not switching between products much, or not as visibly to us. So slight dynamic there.
Okay. Well, look, we'll move on to the final topic, being the new loan level RMBS and ABS reporting standards, and for repo eligibility when these went live in 30 June 2015. And so, Dickie, it'd be good just to give us a quick health check on how things are going with the reporting.
Yes, I think from a health check point of view, I think there's been some very strong engagement from the entire market. It was an enormous effort in terms of actually achieving getting the loan standards in place from 30 June last year. Obviously, I think the standardisation, quality and consistency of data now has improved dramatically again from where we were. In terms of the size of the data, it was significantly larger from, typically as Perpetual's performed the data warehouse function in Australia. We were typically taking in one file with 33 data fields, and that changed from taking in 4 files with over 500 data fields. So the amount of data being available now is significant, and that quality of data also in terms of the requirements were very stringent around what the Reserve Bank came out with, and Perpetual matched a lot of those validation rules to ensure we validated the data on the way in, to ensure that consistency and standardization of data had that consistency going out to market. So hopefully that's seeing a real improvement throughout the market and will continue to improve going forward.
And did you also want to comment on some of the industry challenges around the introduction?
Yeah, so again, with so much data coming in, there was a lot of complexities involved. One of those was privacy. With the amount of data and the private nature of that data, we've obviously had to be very careful and meet regulatory requirements, privacy requirements. So we're working really with the industry now to understand how can we make the low-level data available, but a lot of the market are very happy with the aggregated data. They're very happy with the data which have been provided for the last 10 years. And I think, as Neil commented earlier, the consistency and standardization of the data which is available currently is actually meeting a large part of the markets and investor needs. So that's a positive where we are sort of working with the ASF and the industry around how do we sort of make the low-level data available to those specific investors.
And the final question is around the benefits of the new reporting standards. If it'd be good to get your view on that.
Yeah, look, I think the real positives, again, I'll sort of quote you, Neil, who talked about the predictive analytics. So I think Perpetual's got a data warehouse which is, back since 1997. So the reality is now that the data has improved significantly from 2003, and now, again, there's a quantum leap in terms of the improvement and consistency of that standardization of data from the RBA's implementation of data standards in June 2015. So I think, we talk about innovation and there are big words, but I think the reality now, we've got such a good data structure, and I think the real quantum leap in terms of the big global technology firms like Google Analytics, Salesforce Analytics, Microsoft Cortana Intelligence Suite. So we can really leverage off those technology suites with the data and actually provide a much more visualized product to market, and we can also then use the analytics to actually do predictive analytics, look at trends, look at time series over that period of time through those cycles to actually give more insights into the market.
Okay. Look, that pretty much wraps everything up. So in summary, in the ABS sector, it's and specialist mortgage, it's a fairly exciting time. There's a lot going on. Innovations, but at the end of the day, it looks like we finally in the coming years might have a few more issuers in that market and hopefully help build liquidity. So thanks very much to the panellists and thanks for listening. Cheers.